Hello and welcome. You're watching KYC here on NDTV Profit. I'm Harsh Saita and we're going to be shortly joined by Mahima to break down what is a tough set of numbers for Avenue Supermarts, but we'll also break down the business more importantly. Try and talk about what's happening there and give you more perspective on what we can expect going forward as well. Let me dive straight into it. Commonly known as DMart. It's a supermarket chain, sells everything from stationery to food items, all of that within under one roof. That's the breakup with regard to the revenue in terms of categories, food, non-food, as well as other. And broadly, it owns the real estate and therefore slightly capex heavy in terms of the business itself. It owns the real estate, it builds its store, and thereafter is able to offer deep discounts to customers, and that's what helps it stand out in the marketplace. Competition, of course, coming through from quick commerce players, which is currently where some of the pressure with regard to numbers is coming, and we'll dive into that and try and give you perspective. But let's first talk about what parameters we look at today on this edition, given DMart. Well, we'll first start off with the income statement check. We'll also look at the balance sheet. We'll look at return ratios. We'll look at the cash flow as well. And thereafter, we'll look at the shareholding, the street cred, how the stock has performed, the street coverage, as well as valuation. So we're going to consider valuations as the 8th parameter today, which we keep changing depending on the nature of the business. But that's how we'll try and break this down. Let me quickly go across. Mahima's joining us, and Mahima, take us through the income statement.
Right. So to start with, the 4 parameters for an income statement. Revenue for 9 months FY24 stood at 43,327, and this is up YOY 17%. So an improvement in Q3 has, made this number jump to 17% YOY. First half did not look very promising for Avenue Supermarts, and a 3-year CAGR in terms of revenue has been around 22%. In terms of EBITDA, it stood at 3,561 for 9 months FY25, where we saw a growth of 13% YOY, and its 3-year CAGR, EBITDA CAGR, has been around 33%. So thumbs up for that. Margins have remained within the range of 8.2% in 9 months FY24, but they've slid a bit in Q3 because of heavy discounts given by the company. Net profit is the last line item, where the net profits as of 9 months FY25 stood at 2,307. YOY, it's been up 10%. And overall, 3-year CAGR for net profits has been 32%. So, with respect to the income statement check, it's a thumbs up for Avenue Supermarts.
Okay, so that's how the income statement looks like. Let's look at the balance sheet as well while we're at it. The net worth is to 20,811 crore, extremely profitable in that sense, the company. And a lot of that is lying in its net worth. Hardly any fresh issues that you'll see coming out of DMart. So, entirely a growth-focused kind of company. Balance sheet is, in terms of the gross debt, it looks large because you have a lot of lease liability. So, predominantly that entire number is lease liability, and therefore the debt is minimal to zero in this one. You're looking at cash and bank balances of around 260 crore. One quick piece I want to try and highlight, and we always try to do that, is the market cap, 2.32 lakh crore. So it's trading at nearly 12 times its book value currently, Mahima. And just for perspective, because book value is the number that we spoke about earlier, the net worth, and therefore certainly doesn't look reasonable in that sense, given the kind of net worth that it has. But it's an extremely strong brand, focused largely on value retail, on everyday items, and that's the target audience that it has. Last off, with regard to dividend, no dividend payment made by the company historically. Always churns its balance sheet in a way that the cash flow, free cash flow generated goes straight back into the business, reinvested into the surplus, and that's what's showing on your net worth. But
absolutely.
Mahima, back to you on the third metric.
Right. So the third metric is the return ratios.
Yeah.
We'll consider as to how return on net worth and return on capital employed has panned out. If we see the return on net worth, it was around 12% in 2022, but it rose to 16.8% in 23. But it has come down a tad bit to 15.1% in 2024, and where the first half of FY25 stands, it stands at around 7.6%. With respect to return on capital employed, 2022 was around 15.6%, but it jumped to 20% in 2023. But 2024, it came back to 19% levels, and the first half of FY25 suggests a 9.6% on ROC. So, since we've seen a slight slid in both of these parameters in 2024, we've kind of given it a neutral rating, and we'll wait for how FY25 overall pans out with respect to these return ratios. They do not look very far away from the 2024 figure as of now, but we'll have to wait and watch, with respect to the earnings and how the share price, goes ahead and, pans out in the last quarter of FY25.
Yeah, it's certainly been a tough couple of quarters, Mahima, for this one, and that's reflecting on the return ratios. Essentially, in that sense. Let's look at cash flow as well now. In terms of cash flow from operations, very, very healthy in terms of the growth. What are they optimizing on? And we'll have, there you go, the numbers are in front of you. But what are they optimizing on? In terms of receivables, they are trying to reduce their receivables, reduce the amount of inventory they have, so they are optimizing on those two. They are also able to leverage on payables because of the scale and size that they deal with. Their working capital requirements, while they are large, they are shrinking on a large base because the growth is strong, and they're probably able to leverage some of the scale on to some of the parties that they purchase from and vendors that they purchase from, and that's reflecting on especially the operating cash flow. The operating cash flow has grown very well. It's doubled over the last 3 years odd, and therefore it's reflecting well on the numbers. The net cash flow, of course, slightly muted because the kind of investments that the company continues to make is fairly robust, and therefore that's how cash flows is playing out. It's definitely a thumbs up because of the way in which operating cash flow is moving. You can see that on your screen. Very, very healthy growth there.
Right, understood. And the next parameter, that we'll be throwing light upon is the shareholding pattern. Now, in this, it's thumbs up for the company because promoters have not offloaded, since quite some time now. The September 24 promoters holding stood at 74.64%, which has been the case in June as well. The FII's slight increase in their holdings for Avenue Supermart from 9.2% to 9.95%, which is almost 10%. The DIIs have, kind of seen a reduction in the stake. It was 7.95, that is 8% roughly in June 24, which came down to around 7.4%. Government has a holding of around 0.7% in the company, but public shareholding, that is the retail shareholding, has also come down, slightly, which is from 8.09 in June 24 to 7.91 in September 24. But overall, if you see the shareholding pattern, Harsh, it's a thumbs up because the promoters have had their stake intact.
Well, yes, so thumbs up on shareholding. Let's look at street cred now. And interesting here, this is one of those names which has given muted to very, very low returns in the last 4 years as well. So you're looking at just about a 4% share price performance. And this is of course in the near term. The 1 year performance is negative 4%. So a flattish kind of move over the last 1 year or so. The 6-month performance is a tough one, and last 2 quarters is where a chunk of the pain has come through as well. Right. It's a negative 28% over the last 6 months or so. So that's where the bulk of the pain lies. But when you're looking at the move on the stock from March of 2021 till today, you've seen maybe a 7-8% move. So high single digit over a 4-year period. Largely flattish kind of returns. It's been a tough time for shareholders. This among the others, some of the other large caps where we've seen pain, that's where this starts to become interesting. Does the stock move going forward or not? And the last 2-3 quarters has been a tough environment, so to analyze that better. But for the moment, we'll keep a neutral on the street cred because otherwise, this has been a very solid compounder of sorts. DMart, originally also had a very solid business model, always had healthy return ratios, and has always compounded well for shareholders. Can it start doing that or not is the real question. On neutral on this one, where street cred is concerned.
Right. With respect to the valuations, you did mention in the start of the show that valuations, price to book, is kind of expensive. And if we also check, the Bloomberg estimates with respect to the going forward valuations, it does not look very cheap. In terms of the price to earnings, the current price to earnings for Avenue Supermarts is almost 92 times. If we check the FY25 estimates, it stands at around 79 times, and FY26 estimates stands around 67 times, which is still not cheap for a counter like Avenue Supermarts. And price to book currently is at around 12.5 times. The 25 estimates suggest it to be around 10.6 times, and FY26 estimates are around 9.1 times. So the valuation picture is completely a thumbs down, because nowhere in the next 2 years the stock will become cheaper with respect to the valuations. With respect to the targets and the kind of return potential that the Bloomberg estimates have, the buy rating stands at around 12 buys. There are 8 holds for the counter and 10 sells for the counter. So it's a thumbs down here as well, and the return potential is around 10% as per Bloomberg. That is the 12-month return potential. So the next 12 months, 10% upside is what the consensus suggests, with respect to where brokerages are concerned.
Right. Let's list down the performance. Therefore, we've covered all 8 parameters, and therefore let's quickly break this down. Income statement, thumbs up. Balance sheet, very healthy, thumbs up. Return ratios, kind of neutral, because we've seen a taper down with regard to the return ratios. Cash flow, again, looks very, very healthy. Continue to invest in the business, a thumbs up there. You're looking at shareholding, 75% held by, nearly 75% held by promoters, and consistently so, and therefore that thumbs up there. Street cred is a neutral, because it's been a very good wealth compounder, but last 3 to 4 years you've seen a flattish kind of move on the stock price. Street coverage is a thumbs down, because you're likely not going to see very, very good returns. And last off, valuation is a thumbs down, because there's no comfort there. Trading at 12.5 times book, nearly 90 times price to earnings, trailing 12 months, you're just giving it about a 5 out of 8 to Avenue Supermarts. There you go. So that's the rating. But let's talk about SWOT, because that's the other thing we analyze on KYC. What are the strengths, weaknesses, opportunities, and threats? Mahima, I'll start off with the strengths. Growth has never been a challenge for DMart. Of course, last 2-3 quarters barring, growth has been extremely strong for them. They've been able to continuously stand out in the marketplace, and that's a big strength for DMart. Very strong balance sheet, given the kind of growth that they've clocked in past years. The other one is on pricing. The kind of scale that they have, nearly 350 plus stores, it allows them the bandwidth to price out competition, as well as negotiate favorable terms with vendors. And that's another key strength. Any large organization is able to leverage on that size, and that's what DMart does very, very well. And those are the 2 big strengths, outside the fact, of course, that it's a Damani owned company and promoted company, and therefore you have a very strong backing with regard to both promoter as well as with regard to management. But outside of that, these are its key strengths. Weaknesses, currently you're seeing weak growth in the FMCG space, where it predominantly has a large footprint, a large presence. And the other thing is that your growth has started to lag a little bit as a result of the overall industry trend, as well as with regard to competition. So those are the couple of weaknesses which are starting to creep in. into the business. But why don't you take the opportunities and threats?
Right. So just to add a point to that lagging EBITDA growth,
Yeah.
9 out of 10 quarters, its EBITDA has lagged growth, which is kind of concerning, which is why,
Right.
it's a part of weakness where, DMart is concerned.
Fair.
But, moving on to the opportunities, we are seeing that intense competitive pressure is coming in from quick commerce. The company can probably, leverage this as an opportunity because it has DMart ready, as, their warehouses, which they can, probably use in terms of quicker deliveries. They can expand in terms of quick commerce space via DMart Ready. Product expansion is one of the things that they can, have an advantage on. The third thing is that home delivery business now far exceeds the pickup point sales contribution. So DMart Ready is already contributing around 22% to its total revenue. And store expansion is another factor that could, play in favor of DMart because that will increase their overall throughput. Now, moving on to threats, quick commerce, as we all know, is kind of posing a threat on Avenue Supermarts. We saw in the first half of FY25 as to how the revenues were impacted. In terms of margin contraction, DMart, in order to compete with counters like Zomato and Swiggy giving high discounts, which is why the margin contraction is taking place. Their product mix share in terms of general merchandise and apparel, which is a high margin business, is going down, which is why the margins are being impacted, and hence negative operating leverage is taking place. So margins will continue to be under pressure going forward as well, which is why, this is one of the threats that the company has at present.
Right, but as always, let's bring more perspective. This time we've got, not able to speak to Avenue Supermarts, but we'll speak with Jignanshu Gaur, who tracks the counter closely and who's an analyst with Bernstein. Welcome, Jignanshu. Good morning. I want to try and first get perspective from you whether DMart can continue to stand out, and it's a general question to start this conversation off. But do you believe very quickly, 30 to 50 seconds, can DMart continue to stand out in the marketplace given everything that's happening?
Thank you for having me, Harsh. As usual, I think DMart is one of the best retailers in the country and definitely the best grocery retailer in the country. Being the best grocery retailer in the country is an achievement in itself in a market like India. Not many believed you can have $6 billion of grocery revenue at 5% PAT margin sustainably. So I think that will make it stand out materially. Its brand that it has built amongst its customer segments and the operational resonance with that brand positioning is what makes DMart stand out in my view. If you look
Jignash,
at the opportunity,
right.
sorry, go on.
Go ahead, go ahead, go ahead.
No, I think the last point was the opportunity set for DMart, or the key thesis why DMart stands out is its ability to operate stores from metro city like Mumbai to a very small town like a Bilimura or a Vai, which makes it then possible to expand the store network to probably 1,000 cities in India.
Got it.
That's what makes DMart.
Got it. Jignanshu, Mahima also joining in. With respect to the CEO stepping down, we were kind of expecting that he'll continue, even beyond his term. But he has now decided to step down and we have a new management being appointed. How are you viewing this?
It was a surprise for everyone, given that he had a lot of tenure left. However, and he leaves behind a legacy of, like I said, creating the most efficient retailer in India. Net positive, I think, for the stock or for the company is that a change in CEO, especially a CEO who's coming in with very strong execution experience, with very strong international exposure, will give DMart the perspective of expanding its overall strategy, right, and looking at parts which it had not looked earlier. I think the two or three areas which I see as positives. One, probably a more aggressive expansion of store network, especially in states where it doesn't have presence. Second, a little bit more focus on customer experience and providing value to the customer beyond price. So whether we can start seeing digital experiences of the customer becoming better, the DMart Ready app becoming better, and so on. And I think these are areas where it can sort of transition to while retaining the very strong execution DNA which the outgoing CEO has built.
you're extremely bullish with regard to where DMart is concerned. So I'll try and throw you a little bit of a curveball. Mahima mentioned as part of the analysis that in 9 out of the last 10 quarters, EBITDA growth has lagged top line growth. Is that at all a concern for you?
I think in retail business, when your market share is so small, the agenda is revenue growth to ensure customers keep coming back. When we are saying EBITDA growth has lagged revenue growth, as you can see, the CAGR is not materially different. And the 3-year CAGR on your screen right now shows the EBITDA growth above revenue growth as well. So I think the EBITDA has been range bound for DMart. It is in the 8 to 9% range. Within a 30 to 50 basis points change, I am not too concerned. They have enough levers to bring EBITDA margin back. And hence, as long as we get good SSSGs coming into this business, I think margins will take care of themselves.
All right. Jignanshu, I want to understand, they've added 22 new stores in 9 months FY25. Where do you see this number going by the end of FY25 first thing? And despite of the store expansion, we're not seeing a lot of expansion in terms of revenue per square feet. How are you viewing that?
So I think their revenue, so their store expansion first, we have a target of around 40 to 43 stores for this year. So if they have done, as they have done 6 and 10 in the 3 quarters, so that's 22. We expect close to 20 stores in Q4. Last year, Q4, they did 24 store openings. So it's not something, store opening is typically lopsided towards the second half of the year. We expect this rate of store addition to also grow as we go into F26 and F27, potentially by also opening new clusters in states where they are not present. Revenue per square feet, I think as at 36,000 rupees of revenue per square feet, I think they've reached a stage where it just needs to increase potentially with inflation, to offset the increase in costs per square feet. I think this last quarter, the revenue per square feet approximately was 39,000 rupees, which is absolutely the best in class.
What I found interesting, Jignanshu, is you spoke about the fact that there is a need for DMart Ready, the app, to get better in terms of customer interface and customer experience. Now, why I find that fascinating is because competition is coming in a big fashion. And valuation comfort, at least by the looks of it, does not seem to be there. You are trading at 90 times earnings nearly, and you're trading at 12.5 times book again. So what gives you the confidence at this level that the stock can rally another 50% from here?
That's a very fair question. So let me break the numbers down. If you look at the consensus estimates, and my estimates for F27 are ahead of consensus. So at a consensus estimate for F27, since we are at the end of F25, it's around 65 EPS. So at 65 EPS, you are at 48x of F27 multiple. For a stock or for a company which has 400 outlets in an industry where they can easily have 1,500 outlets. So it's still early stage cycle, and we are not rewarding growth the way that we should if we are at current price points. If you look at the price points of companies which are in the internet space or the e-commerce space, the valuations are even more out of whack. So and hence I believe that at 3,500 rupees of share price approximately, at a 65 to 70 earnings in 2027, even if at a 65 to 70 multiple in 2027, it should be at around 4,500 at least, right? I am more bullish because I think the growth will come back and the longer term narrative stays for DMart. I believe that the threat for top 40 cities from quick commerce or from e-commerce will abate towards the second half of this year, starting from the second half of this year, which will bring growth also back and the margin profile back. and hence the EPS estimates can also get revised, and so can the multiples look a little bit more comfortable, even from where they are today.
Jignanshu, so then I think, do you believe that both the quick commerce and DMart have a separate set of audience and they'll coexist? And secondly, I want to understand, you said that discounts might abate in the second half, going forward. But, to some extent, even these quick commerce players are, taking discount and kind of competing with DMart. So to what extent can these discounts go forward? And if you had to choose, between DMart and, a quick commerce player, Zomato versus Swiggy, which one would you pick?
Okay, so three questions, Mahima. Thank you for those. I'll unpack a little bit. Uh, I think when I said the competition for DMart will abate, the rationale is quick commerce. DMart's core strength is grocery. Grocery is a lower margin item, which beyond which is a good tool for customer acquisition, but not a great part of the basket for quick commerce whose cost structure is higher than that of DMart. So I believe that their competition for the customers will move away from DMart's core of groceries, right? And hence the top 10, 20 city competition that DMart faced in Q2, Q3, maybe even Q4 will go away towards the end of the year. Also, as quick commerce competition needs to focus on margins themselves. So I think that is one reason why I think it will go away. Whether discounting will go away or not, I think I think primarily there's only one player who is discounting at the level at which DMart is. Everybody else has already started adding up delivery charges, smaller card charges, and so on, where the pricing does seem higher than what you get at a DMart. Uh, I think on choosing stocks, and your last point, and probably the most interesting and controversial, I think the question is at valuations, whether to who believes a DMart can sustain a 15 to 17% growth for the next 5 years versus sustaining a 40 to 50% growth for the next 5 years while increasing margin, whereas for DMart, you just need to maintain margins in order for the numbers to make sense. So I think it's the belief whether you think company A can do 15 to 17% growth uh, at stable margins versus companies who need to deliver from a different base 40 to 15% growth with margin expansion. Of course, as a research house, I have a co-analyst who covers quick commerce space as well with a different take on it. My take would be at current valuations DMart.
Okay, excellent. Thanks so much, Jignanshu, for coming in, speaking with us. Of course, it's never enough when you're talking about as a company the size of DMart. Not going to be able to do justice, even with a half-hour conversation. But we're going to have to wrap this edition of KYC. Thanks for coming in and speaking with us and giving us that perspective.
Thank you, Harsh. Thank you. My pleasure. Always.
Right, and with that, we're out of time as well on this edition of KYC. From Mahima, myself, everyone who puts the show together, thanks so much for watching. Hope this was helpful. Stay tuned to NDTV Profit. More action on the other side.